In the past 15 years, one ETF has delivered an annualized return of over 40%. This ETF is TQQQ, a 3 times leveraged fund that tracks the NASDAQ 100 index. If you had invested $10,000 in QQQ 15 years ago and held it to this day, it would have grown to around $140,000. But if you had invested that same $10,000 in TQQQ, it would be worth around $1.86 million now. That kind of return is definitely eye-catching, right? However, if you focus only on that single number and overlook how those returns were achieved, you're unlikely to actually achieve them, and may even suffer major losses when the market turns down, because you're fixated on the outcome, the return, while ignoring the journey that leads there. With ETFs as long-term investment tools, realizing those returns depends on whether you could stay invested over time. And that's often the hardest part for most investors. The investment journey is full of volatility and emotional challenges, and without understanding the underlying risk mechanics, even if you've picked a high-return product, you may still exit under pressure halfway through and miss out on the gains. So today, we'll use TQQQ as our example to walk you through 3 key metrics that reflect the core characteristics of the investment process: standard deviation, maximum drawdown, and the Sharpe ratio. By understanding these 3 indicators, you'll be able to evaluate whether an ETF truly suits you from a more complete perspective instead of relying solely on surface-level returns. Let's start with standard deviation. It measures how much an ETF's returns fluctuate. In simple terms, it tells you how dramatic the price movements are. The higher the standard deviation, the greater the volatility. The lower it is, the more stable the price trend. For example, ETFs with a standard deviation around 5%, like some bond ETFs, tend to have relatively stable prices. Most equity ETFs fall in the 10% to 20% range, which is moderate volatility and generally acceptable for most investors. But if an ETF has a standard deviation above 30%, it's like riding a roller coaster. The swings are extreme. For investors who aren't familiar with volatility, holding a high volatility ETF can be a real challenge. Many people feel anxious when facing sharp price drops, and that anxiety often impacts their decision to keep holding. So, while standard deviation doesn't directly determine your final return, it does have a big influence on your confidence in holding the investment. In fact, those who truly benefit from long-term investing are usually the ones who understand a product's volatility profile and choose assets they feel comfortable holding through market ups and downs. Next is maximum drawdown. It reflects the largest drop from an ETF's peak to its trough over a certain period and is an important indicator of risk tolerance. You can think of it as an extreme stress test. In the worst-case scenario, how much could you lose? Take QQQ as an example. Its maximum drawdown over the past 15 years was around 30%. This means that if you bought at the peak, it could have dropped by nearly 1/3. However, with a long-term holding approach, you still have a good chance of earning solid returns. In comparison, TQQQ's maximum drawdown has reached as high as 80%. In other words, during certain periods, a $100,000 investment could shrink to $20,000 or even less. For most investors, such volatility is simply unbearable. Many people believe they have the mindset for long-term investing, but in reality, they haven't experienced a truly severe market correction. When asset values drop by more than 50%, most people panic and even abandon their investment plans. Maximum drawdown helps us understand in advance the worst-case risk scenario and sets more realistic expectations and mental preparedness. Without understanding historical volatility, simply talking about holding for the long term often makes it hard to stay the course. The final metric is the Sharpe ratio. Its purpose is to measure how much return you get for each unit of risk you take. You can think of it as the cost-performance ratio of an investment. Let's use an analogy. Your money is like a team of employees, and you're sending them out into the market to work for you. If these employees work hard, don't take on too much risk, and still bring back solid profits, that means they're efficient and cost-effective, which reflects a high Sharpe ratio. But if they're constantly taking big risks, don't earn much, or even lose money, then the Sharpe ratio is low. Generally speaking, a Sharpe ratio above 1 is considered excellent for long-term holding. Looking at historical data, QQQ has had a Sharpe ratio of 1.01 over the past 15 years, and TQQQ has also stayed within a relatively reasonable range. However, it's important to note that the Sharpe ratio is highly sensitive to your entry point. If you enter the market at a high point like in 2021 instead of from a bottom, TQQQ's Sharpe ratio could quickly fall off a cliff. If we zoom out and look from 1999 onward, covering events like the dot-com crash and the global financial crisis, even a relatively stable ETF like QQQ would see its long-term Sharpe ratio drop to around 0.45. And for TQQQ, which is far more volatile, the risk-adjusted returns would naturally be even lower. So, the Sharpe ratio doesn't tell you how much you earned in total, it tells you how much risk you had to take to earn that return. Many investors overlook this part and only focus on performance, without considering the cost behind those gains. The Sharpe ratio helps you evaluate both return and risk together, allowing you to judge whether an ETF is truly worth holding for the long term. I hope today's video helped you understand the volatility and risks that often come with high returns. Investing is never just about chasing the biggest gains. It's about whether you can stay calm and committed when the market takes a hit. By understanding standard deviation, max drawdown, and the Sharpe ratio, you'll be able to make more rational decisions and choose investments that truly suit you, so you can go further and more steadily. That's all for today's video. If you found this helpful, please don't forget to subscribe and give it a like. Your support means the world to me. See you in the next video.